All right, the market had a pretty dramatic seesaw throughout the day today. Obviously, it started off on a really high note as the CPI came in a little bit better than expectations in terms of maybe reducing the odds of another Fed rate hike and maybe increasing the odds of some rate cuts coming soon. So that helped lift the markets really early before the market opened and into the open. And then it sold off. It got down to the lows of the days. Pretty dramatic selling, relatively speaking, right, considering the range that we're in. And then we got a report that from the Fed's mouthpiece later in the day that the Fed may be done after all, and the market rallied back up to the highs of the day. So big turnaround, all centering on the Fed and what they're expected to do. The question is, how bullish? I mean, what was it bullish? Like, did we break out? Right? Because that's what we're watching for. Have we broken out? Are we now trending instead of just ranging? And so we'll take a look at that and obviously discuss that, what the indicators are looking at, whether or not they have flipped from kind of convergence mode, which is what we've been seeing here, to now a new divergence mode, where we're actually making an impulse move, in this case to the upside. So we'll break all that down, what's driving the markets here, and our trade idea. Very common, popular trade right now, and big name, right? And I think one of the names that will carry us through, that considering it's part of that group that makes up 25% of the S&P 500 right now. So, and again, we're looking to get our YouTube channel up to 10,000 subscribers. So if you haven't subscribed yet, click that subscribe button for us, and let's go ahead and get started. Today is Wednesday, May the 10th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right-hand column, including our Market Outlook Live that we do at 3:30 Eastern Time, where we put the trade idea on before the market closes. Come down here to the bottom, click this heart. It opens up this tab, hit that like button. Also, same thing here. Click on this thumbs up icon. It takes you to this other tab. Hit that like button there. Again, the more you do that, it helps. The more engagement we get on these posts, the more it helps get our content out to all of our followers. We really appreciate it. It goes a long way for us. We actually did get back to 100, so we really appreciate that, and thank you for those who like these day in and day out. And those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line turned back up today as we started off the day strong on the CPI report, fell throughout the day. Got to a low and then rallied at the end of the day, came all the way back up and almost got up to the open. Really, really close. Obviously a lot closer to the high of the day, which is early, than the low of the day, which was kind of in the middle. So as a result of that long lower shadow, sitting right at resistance no less, the intermediate line turned higher. The momentum line came up, like resurrected from that extreme low point it had, the third extreme low point at that intermediate line. Now, granted, this was the momentum line dropped down to those low levels this time because they had really, really small ranges heading into today, right, with the CPI report, as well as the debt ceiling meeting that that came out the night before. And this drop into extreme lows did not have the near-term line accompanying it. So the near-term line actually stayed up here. And just like that, your momentum line has bounced back up. The last couple of bounces didn't really get very high, or have been getting progressively lower. And we'll see if this one gets higher and actually gets up into this upper reversal zone to really help the near-term line out. Because the near-term line has crossed below market sentiment. It's not that big of a deal when it's below market sentiment. The intermediate line. When the intermediate line is in the reversal zone, it's okay for the near term. You can still be bullish. It's obviously not. It's like a convergence period, but it's still okay. It's when you are outside of that reversal zone in the intermediate line and the near term line's below it. That's when you're not so bullish. The intermediate line still above market sentiment, so that's a positive development. And we are still above the moving average, about 0.5%, but we're still above the moving average. So you are looking relatively well. Of course, the Dow Jones Industrial Average was your weaker one today. It actually got a bull tag here yesterday, trying to bounce off that bull tag that I got, originally over here, and trying to get, bounce off a new one. But we actually finished below the moving average again today, with a pretty decent range there, well above the average for the range. And of course, again, the near-term line, the intermediate line is not in the reversal zone, so the near-term line falling below it is a bearish sign. And we can bounce right back up above it tomorrow, but as of right now, that's a bearish sign for it. And just like the S&P, the momentum line, really liking this move off of the lows of the day today, getting back up. Intermediate line still above market sentiment, so that's still working in our favor. On the other hand, the Russell 2000, which has been the weakest, its market sentiment line still falling towards that reversal zone. Your near-term line is still above the intermediate line, but the intermediate line is a lot lower. So keep that in mind. That's a pretty significant difference between the other indexes. And of course, your momentum line bouncing today with the move off of the lows. And then finally, your NASDAQ 100 has got the strongest intermediate line. It's actually still in the reversal, the only one that's still in the reversal zone. Momentum line coming up off of the extremes, and the intermediate line up above. And remember, the near-term line is below intermediate, but that's okay when the intermediate line's still in the reversal zone. It's only when it's below that. So NASDAQ continues to look stronger. The NASDAQ's well above that February 2nd peak. The S&P is not. The Russell's really not. But the NASDAQ's well above that. In fact, the NASDAQ is flirting with its August peak, if you see over there, which, from a money flow standpoint, as we now approach that August peak, if you look at like the Qs, from a money flow standpoint, you can see like here we are. We got that cluster a few days ago, but here we are now. So you really have to go back to right here. We closed at 325.93. That peak right there. So you follow my cursor to the right, you notice even though we are at equal levels in price, it's not been supported by equal levels in volume. The volume's nowhere near that level. At least we have the money flow jumping up above 50. That's not the case for the spiders, right? It jumped up, but it only jumped up to 48. And like I said, not getting the support there on that. The breadth looks a little bit better, finally. I mean, it is minus 11. It's a lower number than what we've seen the past few days, but it's still negative. And if we get anything below minus 25 tomorrow, then the summation index will actually move below zero. And that's, with the stock holding, at least holding at resistance so far, would not necessarily be the best sign for that. Let's take a look at some of the other charts here. So we'll take a look at our weekly chart. Again, we've been getting transition after transition, and it's just not, we're not breaking out. In fact, we're getting a smaller candle. The size of the candle is still below its moving average down here, or the 3-day moving average, 3-week moving average in this case. Even though PPO is rising, it's still not above. It's not very far up here. It's only at about 1.5%. So not really what you want to see there. The Russell 2000, of course, is still in the death cross environment. And your NASDAQ, which has been the most bullish, is actually getting a pretty decent bullish candle today and continues to move higher there. So you can see the discrepancy. Of course, your Dow Jones Industrial Average is kind of stuck in the middle as we are getting a bearish candle. It's the only one with a bearish candle, and potentially getting a red arrow there. So we want to keep an eye on the Dow over the next 2 days and see how it closes this week. From a 3 green arrow standpoint, we still have our 3 green arrows on the NASDAQ, but that's the only one. We have red arrow on the diamonds, right? We actually did get the red arrow there. We have 1 green arrow, so that's why it's not pink. We have 2 green arrows on IWM. We were that close to getting 3 green arrows. And then the S&P, we have 2 green arrows, and we're that close in the MACD to getting a 3rd one. So but we're not 3 greens, only in the NASDAQ as of right now. Looking at the 2-line versions, you can see we did close well above the 8 and 17 day. The 8 still above the 17, the MACD still positive. but the MACD is not above its moving average yet. And you can see the convergence in these lines. Stochastics crossing above, pretty good, decent volume after 2 days of no volume down there. Of course, your diamonds did close below the 8 and the 17. Even with the rally, we still closed below the 8 and 17 with the MACD that is below its moving average and negative. On the other hand, your Qs, which has been the most bullish, is well above those moving averages. Even the MACD kind of subdued, it's well above those moving averages there. So, some good strength continuing in the NASDAQ 100 will be a theme for our trade idea today. From a DMI standpoint, you are above 25 on the positive indicator. You are now below 25 on the negative, but still not strong enough of a move to get that ADX to really work out, to get going. Your NASDAQ is, you are above 25 and well below 20 on the negative. Your diamonds, however, you can see it's the other way around. The negative's above 25 and the positive is the one that's dropping. And that's kind of similar to what we're seeing in IWM as well. The negative is above the positive, even if the positive there is slightly above 25, trying to make a run. Looking at the RSI and the CCI, again, above 0, above 50, but not strong bullish levels in either one of those. As I mentioned, the Dow Jones Industrial Average is worse. We're below 50, or at least flirting with 50, and below 0 on the CCI down there. So you can see the weakness and some of these other indexes that aren't so influenced by what's going on in the FANG names. In fact, the Dow Jones Industrial Average only has 2 of those 7 stocks, and the 2 biggest ones, and Apple, Microsoft make up about 9.5% of the Dow. They make up 25% of the NASDAQ 100 by themselves, just those 2 stocks. The other 98 make up the other 75%. And then, of course, those 2 make up 14% of the S&P 500. So the Dow is where they have the least weighting out of the 30 stocks in the Dow. And, of course, they have 0% weighting in the Russell 2000 because they're not listed in that particular index. That's why you see those 2 showing more weakness than others. I've been mentioning the S&P, the hole on the S&P. Remember, we do have a green hole now, and you're above the 200-day, so that's a good bullish combination. You don't have a very good sized candle. It's positive, but it's not above this 2.5% mark. You're not above the moving average yet there, and you're still got the parabolic SARs above us. So remember, we have more flexibility for some volatility here to the upside than we did over here when you were so close. By the time we flipped the parabolic SARs, we weren't very far away from it, so we were easily able to flip it back, right? Well, that's not the case right now. They're a lot higher, so it's going to take more of a bullish move to flip those down to the downside. But of course, if that happens, that means we're really kind of breaking out here and starting down a lot more bullish path. All right, now let's take a look at today's trading, the intraday range. So we'll go right here, and you can see we did fill in the gap from yesterday. We finished filling in the gap from yesterday. We still have this gap here that we never did get inside at all. We got down to the top of that gap today at a low point, but we bounced off of that, didn't fill in, and continue to bounce up. Now we filled in the gap from yesterday morning. We don't have to worry about that anymore. A little bit of a gap up there. That might be an issue here, but you can see the high and the low are moving. They're both dropping below 70 here, so and the channel width is really low, so we are still setting up for a breakout move. You can see there's no trend. They're both at really low levels. The 26-day rate of change with this red line is barely positive. It's barely above the price where it was 26 days ago. We are still below the average there on the stochastics indicator. And let's take a look at the Bollinger Bands and the Keltner channels. You can see we are not in the upper quartile. So we're bullish, we're in the upper half, but we're not strongly bullish to be trending. You can see the bands are inside the Keltner channels, and we just have zero momentum right now in either direction. It is negative, the momentum is negative, but it's so small there just is no momentum. Remember, there's a difference here. The Qs look a little different. We are easily in the upper quartile. We are trending higher. We're not outside the Keltner channels, and the bands aren't outside the Keltner channels. Your diamonds, on the other hand, we are in the lower half of the range. The diamonds is the only index of those four that we are trading below the point of control for the past year. Everything else, we're above it. The Russell's got the lowest of the year, but this has got the highest for point of control for the 1 year chart, and we are below it. So that's kind of an interesting pattern, and you can see we were right smack dab in the middle. Like I said, with the momentum changing there on the Dow Jones Industrial Average. Today's volume and range you saw was higher today, finally, after 2 really small days, small ranges, small volumes. Today's range was above average and the volume was above average. So we finally hit some higher levels there, but that didn't mean that the VIX rallied. In fact, the VIX finished today lower, and is this, what did we finish today at? Here, let me open this up. We finished here at 81.5%, so below the 82% mark, really low level, and the correlation with the VVIX is moving back lower because even though we dropped on the VIX, we actually rallied on the VVIX, which is going higher and getting closer to 100. So again, that divergence between the two usually leads to a move on both of them going higher, and we'll see if that's going to be in the cards. Remember, the VIX has been extremely low below some of these average values, and we've been converging for a while. So we're kind of basing, and you would expect the convergence to turn into a divergent move in the opposite direction. In this case, it would be, since we were bearish, the opposite move would be to the upside on the VIX. All right, now let's take a look at the different asset classes and how they did today. Let's go to this chart here. Of course, you can see gold and the Qs have been such big winners over the past few months. Let's just take a look at today. And again, you can see the Qs. The Qs and bonds this time. Of course, real estate has kind of been matching the Qs lately. But bonds really rallied today. Again, with this idea of inflation data coming in soft, that's really brought yields down, commodities down, gold down, and the dollar down. So very kind of risk on from that perspective. Just some weakness in some of these international areas relative to U.S. equities and the dollar itself. So it's kind of interesting to see how much weakness actually you did have without the dollar being so bullish. The dollar had been bullish, so that's something to keep in mind. We had we had a good day yesterday, basically filling in the gap today, but the dollar's so sideways. We're below it, and it's really low relative to the 52-week range there. You can, look at TLT and the move it's had. It's again below its moving averages, and you rally back up to the 8-day, and you are below the point of control there, which is right smack dab in the middle of the 52-week range. Couldn't be more sideways in that. So it's not. It's TNX getting a lot of pub that its yields are dropping. We did drop back below 3.5%, fell below the 17 and the 30-day moving average, with the MACD dropping back down. But we're still easily in the middle of a range that it's been in for the past expiration cycle and a half. So hardly a breakout move at all. And you would argue not really that big of a range to go with it. So, but the interesting move that we had today intraday was in Bitcoin. Now, Bitcoin did rally too. So you ended up with a lower shadow. But look how close we are to breaking the 50, which would throw in, filling in that gap between the 50 and the 200 moving averages in play. Getting off this resistance level at 38 and moving back down towards that 23% retracement level. So Bitcoin had a really significant intraday move and rallied at the close, just like the stock market did. But it kind of goes to show, with the Nasdaq not being that bearish today, and Bitcoin having a significant drop on an intraday basis, kind of goes to show where, where risk appetite is right now. Looking at the 12 grid for the different major sectors in the U.S. and how they did, You can see dark green shading the green line in those cyclical areas up there, as well as in the safe haven areas down at the bottom. So, I mean, and you can see light pink or dark pink shading on those cyclical areas in the middle, except for industrials, which has got the light pink shading. You can see we don't have green lines on either one of these. So it is a safety trade with the mega caps joining the party, so to speak, in terms of being considered safe haven assets themselves. All right, now let's take a look at our trade idea of the day, and it's in that mega cap space, and it's Google. Google had a really, really good day today with their event coming out and already through its earnings. But look at this nice little breakout pattern. You can see how sideways we were pretty much since the exhaustion gap at its last earnings, where everything peaked there with clusters. But then we kind of tested it multiple times. It's been converging with the moving average. But then you had this move here today that kind of broke us above these highs, well above those February 2nd highs. Remember the February 2nd high here at that earnings announcement, we were 16.5% above the moving average. Now we're only 5%, so and it's rising. So we're pulling away from a rising moving average. You can see on the weekly chart for Google that you got the golden crossover here just a couple of weeks ago with the 10-week crossing above the 40-week. As of right, we had a bullish trend. We got some transition candles that didn't play out to a bearish move, and now we've closed above the high as of right now. Obviously, we have 2 more days left in this week, but we're closing above the body of that high, and we're going to get a pretty strong bullish candle next week because we're trading at that high point there. So good week here. If you look at the chart, 3 green arrow chart, we had 3 green arrows yesterday, but today is the first day we had a good spike in volume. So really good breakout type move there as well. If you take a look at this chart, you can see we were kind of flirting with the point of control, but now easily above the 8, 17, 30-day moving average. The MACD had been converging this entire time and now has turned up with a pretty clear bullish move to the upside. Stochastics getting up above the 60th percentile. You can also see that here in this stochastic chart in terms of where we're at relative to the 4-week range. We are above the moving average. We had gotten above it a couple days ago, and now easily into the upper quartile or the upper quintile up there. Looking at some of the other oscillators that confirm the breakout, getting above 30, below 20 is a breakout pattern on the DMI, and the ADX is low and turning higher. So that's a good sign. Your RSI and your CCI are also showing breakout patterns. The RSI getting well above 60 and the CCI well above 200. So very, very strong breakout moves there on those stocks. You can, if you look at the whole too, you can see it here too. The big, green line. The parabolic SARs are down, and you got a pretty decent sized candle. Very, very good signs all across the board. I was going to show the Ichimoku cloud. So we are well above the cloud, the strong positive rate of change, and we have a mature trend. So we're above 5 now. We've been kind of working our way up to that, but we cleared the 5 level today and above 80 on the daily chart. On the weekly chart, you can see we had been kind of flirting with the cloud for resistance. We're now above that cloud, working into it, and you can see that the long-term trend hasn't even started. So we might just be getting going here on Google with the either or that, or it's a colossal fake out, which is why we got a position size just in case it is a colossal fake out to the upside. Big break above the Bollinger Bands, which were really, really low on had broken below the 150-day range to new 52-week lows on the bandwidth. Now it's turning up because we're broken out of the band and the Keltner channel. Very, very good bullish patterns all across the board. So what I decided to do here was say, okay, well, let's buy a call option. Let's go out as long as we can to give ourselves some time and buy a call option. But we bought the at-the-money call. I put a stop order at 50% of that. And then here's the trade idea going out to September expiration. Again, we have, I think we end up getting in at, 875. So half of that is our risk of where our stop order is. And then, of course, that's right around, $440 roughly. And our maximum gain up here at about $1,200 if, again, assuming equal volatility. But and that's by September expiration. That's one standard deviation. Of course, two standard deviations move when you get a breakout like this is not surprising, and that would be like a $2,000 or $3,800 move if we were to get up to 160. So good strong pattern all across the board for, again, $400 of risk if it doesn't work out, and we trigger our stop order on this trade. If it ends up being a colossal fake out, and we trigger our stop order on the trade. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out of the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have, and reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, follow us, subscribe to us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your day, everybody, and we'll see you all next time.